All right, so let's begin the highlight of the show, active funds and fund managers that got the market sentiment right. Yes, today on the Money Show, we will analyze the fund strategies across market caps that were able to make right calls in terms of their exposures to specific sectors and stocks. And for this, we are joined by Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth. And good evening, Feroze. Welcome to the show. And you've got an in-depth research ready with you about the funds and hit fund managers strategies as well. But then, before we proceed with the details, I really want to understand what kind of strategies on a broader level have worked for what kind of funds. If you could just give us an overview.
Yes, Kavita, there are several strategies which have worked. Some have not worked in different periods of time. If you look at the most contemporary place, what has worked has been value. Post-COVID, value has always outperformed the broader market largely. But yeah, if you break that down into different phases of super bull phase, like last financial year was not a great financial year from a Nifty standpoint. But this financial year, we've seen about Nifty go up about 11%. So to answer your pointed question, dividend yield, which is also in effect value, because quite a few dividend yield stocks were quoting at reasonable valuation. So value, dividend yield have done phenomenally well post-COVID. What has also worked in pockets is the contra fund. Because somebody taking a contrarian bet last year made a lot of money because the markets were not a one-way street. So these three have stood out. Of course, diversified funds have done phenomenally well too. But in this financial year, if you see, when mid-caps and small caps have run up beautifully, mid-cap as a category of the full funds have given 28%. But if you compare that with the relative benchmark, they've underperformed. In spite of 28% return, if the index has delivered 33, that has one big inference to make. Whenever the markets run up significantly, it becomes difficult for a diversified fund manager to even catch the index. So big return, bad alpha. That's the same theme with small cap, if you notice. Small caps as a category average have given 31%, but they've still underperformed their benchmark by 9%. So for an investor, he's happy that he's got 31%. But alphas have been bad. That's because when the market is running up, if there are 250 stocks in the small cap index, as a fund manager, you don't believe in all of them. So you're going to be very picky, and some stocks which you left out from your portfolio run up in this whole chase of liquidity.
All right, so now let's get into the analysis of the research that you have ready for us. We're talking about active strategies where obviously the investor gets the benefit of having a fund manager attached to their fund who takes care of their money. So when we talk about these funds who've got the calls right, what were your parameters while making this list?
Yes, Kavita, this is predominantly past performance. It's a dissection of past performance. That definitely, before I get into that, also it's from a disclaimer standpoint. Past performance is not the best way to select a fund, but this is just to dissect and see whose strategies have worked. Now, in the large cap category, there are two funds which have done very well, which is the Nippon India Large Cap and HDFC Top 100. Both have a little diverse. They have a diametrically opposite strategy. Nippon Large Cap is reasonably a growth principle with 21 PE, but HDFC Top 100 is a value principle with only 15 price to earning for its whole portfolio on a weighted average constituent basis. So Nippon and HDFC, both one from the growth side, one from the value side, they've done very well. Now, what has attributed to this performance is both these funds have had their top exposures in terms of sectors as banking, IT, and diversified FMCG. So both of them have the same sector allocation, and that's why both have done well. One has not been so sensitive to value. The other has been very, very specific to have a 15 PE in a market like this. Is a conscious decision at the HDFC fund level to keep it value. So these are the two funds on the large cap category which stand out, and they've generated alphas of about 5.7% and 2.2% respectively with their benchmark.
So what has been a sector allocation, and looking at the large cap category and the lull movement, these funds have outperformed. What do you think was so unique and different about these funds and the exposure to different sectors and stocks?
Yes, Kavita, if you look at some sectors have done phenomenally well in this almost 6-month period, which we are talking about from 1st April till date. So what has worked is banking has delivered very well. Their valuations are not as high. Relatively, they are higher from where they were, but there are so many sectors which are commanding 40, 50 PE as well. But in that space, banking is still in the range of 20, 25 PE. Both these funds have an exposure of 25% in Nippon and 30% in HDFC are from the bank exposures, which is a high exposure because Nifty itself has a 33% exposure to banking and financial services in total. IT as a sector, what it did was it had done very badly. Bottoming out was clearly seen in this financial year. After the June quarter results, you saw bad results resulting in stocks moving up. That's a huge sign of a sector bottoming out. IT's reversal and bottoming out has contributed to 5-6% alpha of the IT index over Nifty. And that's really contributed to these alphas. So these two sectors where they have an exposure, top two exposures have done well. They've also had FMCG, which both of them had an exposure of close to 7% in diversified FMCG. All these sectors have generated some alpha to Nifty, and that's helped them to beat their respective benchmarks.
All right, so large cap category, Nippon India large cap and HDFC top 100, alpha 5.7 for Nippon India large cap and for HDFC top 100, 2.20. We move on. Feroze, the next category in focus for you is large and mid cap, is it?
Yes, absolutely, Kavita. The chronological order, once you've finished large cap, then you go a little more adventurous and go to the next 150 stocks, which are called mid cap. So large and mid cap is the next category. Mahindra's Manulife large and mid cap has done well. Large and mid cap for a year like this year has generated good return for the fact that mid cap exposures of 30-40% these funds can carry. And they do also, both these funds, Mahindra Life large and mid cap and HDFC large and mid cap, because of their mid cap exposures and the mid cap index delivering significantly better than Nifty, has resulted in their both these schemes giving an alpha of 1.3 and 2.7 with respect to their benchmark, which also has mid cap. So I'm very happy that a fund could beat the benchmark in spite of having mid cap weightage, because standalone mid cap funds have not been able to very comfortably beat their own benchmark. So these two funds have shown some degree of resilience in terms of lower volatility and still delivering an alpha.
Talking about the strategy, because it's a large and mid cap category, do you think the fund manager has a bigger universe to select from, and so a lot of things depends on the kind of exposure you have towards sectors and stock, and what is it for these funds?
You're absolutely right, Kavita. See, if you have two large spaces, large and mid cap is top 100 plus the next 150. So you have a reasonable space of 250 stocks. And also these guys have the freedom of having some exposures to small cap. So in a large cap, people will definitely not venture into small cap. Like the large cap category, the two funds I discussed have negligible exposure to small cap. Of course, Nippon has 4-5% exposure to small cap. But since it's a large and mid cap fund, the fund manager actually expands his tail and also tries to venture out in the small cap space. And that's a very smart thing to do in a space in a year like this year, like Mahindra Manulife large and mid cap has 19% exposure to small cap, which is not a small exposure by any stretch of imagination. And that's given him some extra alpha. And they've also maintained some 4-5% of cash position or cash equivalent. And so to answer your pointed question, yes, it gives you a larger canvas. Point two, in a large cap fund, it's more top down kind of a strategy where the fund manager is very, very specific in terms of which sector, what weight. In mid cap and large cap, as a combo, you can still follow a stock specific bottom up strategy because of also the small cap exposure.
All right, so that was large and mid cap. The next category would be for you, a mid cap?
Yes. Again, going in the chronological order of market cap, mid cap comes to the next category. In this category, Nippon India Growth Fund, which is a very, very old fund, way back in 90s it started. That fund has delivered a great kind of alpha. The alpha is from a perspective of course, the mid cap index. It has generated minus 1.1 alpha. In spite of that, it is in the top. So this is the point to note as an investor. That means all mid-cap funds in this period of close to 6 months have underperformed their benchmark. Why does this happen? When the mid-cap index runs up and creates new peaks, it becomes very difficult for fund manager to pick all those 150 stocks, because he would not like some stocks in terms of valuation, governance, management, or any other risk which is there. So the best fund in the mid-cap category is still negative alpha with respect to the benchmark, and that's Nippon India Growth Fund. The next one is Mahindra Manulife Mid-Cap Fund. That is also the second best fund from a alpha standpoint, but it's still minus 1.5.
And so this also creates a case to have a passive mid-cap fund?
Kavita, in my opinion, when you get into mid caps and small caps, mid caps not so much, but still, I would not buy index funds in mid cap category, because it's about managing risks. When you're managing risks, there are some stocks which will run up significantly because of their lower free floats or lower volumes. But I would not want to buy it because I don't like the business. So, of course, in the short term, I'll miss out, but it's also about managing the risk. More so in the small cap, but mid cap, that's what gives me the fear. If you do mid cap investing, all 150 stocks will be a part of your portfolio. It's not like a Nifty index fund where 50 stocks are there, the top 50, but 150 might still have some bad apples, not necessarily from the business standpoint, but at least from the price and the valuation standpoint.
And so these funds have sector allocation. Any similarities in that? What's been the specific as far as the exposure of these funds are concerned?
Yes, I think finance and bank in both these have been 20%, 22% as a total. This year, largely financial services has done its duty in terms of earnings also, and also the performance. And since it's the largest weightage in most of the indices, these funds also have about 20%, close to 20% in Mahindra Fund, and close to about 21, 22% again in the Nippon India Growth Fund for these two sectors.
All right, so Nippon India Growth and Mahindra Manulife Mid-Cap in the mid-cap category. Next on your list is, Feroze?
Multi-cap fund, Kavita. And that's a category which is reasonably well diversified, because as a fund manager's mandate, SEBI says that you'll have to have 25% each in all the three categories, which is a mandate. Then you have only a discretion of the other 25%, which you can put in any of the three categories. So 25, 25, 25 totals to 75. The other 25 is at a discretion. So Nippon India Multi-Cap Fund, again, one from Nippon's stable, is 40% in large cap, 28 in mid cap, and 32 in small cap. So of course, the discretionary 25% has largely been skewed towards large cap, and rightly so. This fund has generated 3.3% alpha over its benchmark. So it's but obvious that this category has been the best, one of the best for this financial year so far, because mid-cap category, the best fund has underperformed, but here the best fund has actually outperformed the benchmark by about 3.3%.
And a similar case in flexi cap, or it's slightly different because most of these flexi caps have been large cap biased, or we've seen better alpha in flexi cap also?
No, FlexiCap has delivered lesser alpha, because FlexiCap gives you more flexibility, and fund managers have had this tendency of making FlexiCaps large cap heavy. So in a year like this year, where 15-20% alpha has come over Nifty with respect to mid cap and small caps respectively, so some FlexiCaps have underperformed a multi-cap fund because there's no such mandate to have at least 25%. So if you see the other fund, which I was going to speak about on the Kotak multi-cap, in the multi-cap category, Kotak multi-cap, which is Harsha Upadhyay is the person who manages this, also has 40, 25 and 27 in large, mid and small respectively. So all these funds have a serious exposure to mid-cap and small cap, unlike a flexi-cap, which turns to be a large cap heavy kind of a strategy.
All right, quickly we move on, and the next category in focus is focus funds. This is going to be interesting.
Correct. The focus fund as a category, to my mind, is the mutual fund's answer to PMS. Because PMSs generally have a large exposure of HNIs. For a retail person, focused as a category is the retail man's PMS, with huge transparency, great tax efficiency, no separate demat account. So focus funds are a great niche in themselves, because you can't have more than 30 stocks in a portfolio. But if you speak of a mid-cap fund, there are mid-cap funds with 70, 80 stocks in their portfolio. But a focus fund, on the contrary, is by mandate restricted to 30, and several of them don't even use those full 30 and have 20, 25 stocks in their portfolio. So Nippon India Focus Equity Fund, again, has generated a decent alpha of 2.7% on its benchmark, and still has a PE of 20p, 20.39. Again, large cap biased with 52% in large cap, 28 in small cap, and mid cap is smaller than mid cap is smaller than the small cap exposure, which is a very rare thing to find. 28% in small and 17% in mid, and 52% in large is what this fund stands out for.
Looking at this category, it's a very concentrated category, which should also suit an investor's risk appetite. Talking about sector allocation, what's been very specific for these funds?
I think most of these funds which have come on the top they've got their sector allocation right in terms of banking and IT. Sorry, Kavita, there's so much monotony in terms of this answer because these two sectors have contributed to the alpha, and the ones which we are checking are the high alpha ones. So again, these have close to 35% each, 30 to 35% each in finance, banking, and also these two have one little difference. They have entertainment and pharmaceutical. Pharma is almost about 11% in DSP focused fund, which is the next focused fund, which generated about 4% alpha over its benchmark. So pharma stands out as an exposure, and entertainment stands out as an exposure to Nippon India focused equity fund.
I think there's some technical issue. We're going to come back to you till the time you fix that technical issue. But I'm just going to rewind and announce the name of the funds that Feroze also figured out. And in fact, as per his research, the kind of alpha these funds have been generating. So in large cap category, you have large cap, you have Nippon India large cap with alpha close to 5.7, HDFC top 100, 2.2%. The next category is mid cap, where the funds names are Mahindra Manulife large and mid cap, and over here it's 5.7. That's the alpha for a large cap fund, and the mid cap category you have minus 1.1%. We move on, and I think I've got Feroze back. Feroze, the next category quickly. Let's talk about small cap.
Yes, absolutely, Kavita. If you look at small cap, Aditya Birla Small Cap is the small cap fund, which is the best small cap fund from a performance standpoint. And if you look at it, it's of course a part of our model portfolio for the last year and a half. It was a very bad performer for last year, but now it comes to the top. So why this is important is past performance is not an indication of the future, is exemplified with this example. Like last year when we chose it in the model portfolio, its past performance was so abysmal that it would be very difficult for an investor to cut a check into this fund. And this year, this financial year, it turns out to be the best out of the huge list of small cap funds. So that's Aditya Birla Small Cap. Vishal Ji is the fund manager, great fund manager who moved from PMS last year, April, to manage this fund. He used to manage the PMS in the same company, which is Birla. So this is one fund which has given 36% return, but still has a negative alpha. So that's the second point to note. A negative alpha in the test fund implies that all fund managers in the small cap have not been able to catch up with the benchmark, because the benchmark is running helter-skelter in terms of where liquidity is taking it.
And a similar case in the other small cap fund that you've listed out?
Yes, Bandhan Emerging Business Fund is also one of the funds which has a very similar one. And Manish Punwani is the person who moved from Nippon as the CIO to Bandhan, and that's the fund manager for this specific fund.
All right, let's move on. And the last category in focus we'll take is contra and dividend yield. Is that the category that you're focusing on now?
Yes, Kapita, the second, the Contra fund, again, SBI Contra, which is a part of our model portfolio for the last 2.5 years, has generated about 3.1% alpha. Value as a fund principle they followed, the 17 is the PE of the weighted average constituents of the portfolio, which I think is reasonably low. Pharmaceutical is one of the sectors which stand out. Apart from it, power, which is also one of the sectors which has 5% allocation. So these two sectors have given a reasonable alpha to this fund, and in turn pushed it up right up in the category itself.
All right. So the time is up for me for this discussion, but then I really want you to help our viewers understand the way the viewers can have these kind of funds in their portfolio, the kind of exposure and the kind of placement they should be having, because that's the benefit of having an active strategy. You get the benefit of a fund manager's expertise that we also saw when we got the alpha generating numbers to Feroze. But then Feroze, talking about the placement or allocation in the portfolio, how should one decide on that?
To my mind, first, the implied exposure of at least 50-55% in large cap, 20% in mid cap, and about 25% in small cap. On 2nd January 2023 is when we realized that small cap is going to go through a huge price rating or PE re-rating. So coming back to your point, Kavita ji, 55, 20 and 25 in terms of market cap allocation. The funds which you should choose from should be in multi-cap category, large cap category, contra, dividend yield, flexi cap. These are 5 sectors you can, 5 categories you should certainly focus on, and one large other category could be a focused fund, which is SBI Contra. These 5-6 categories is what you should focus on, and not get into sectorial bets, especially in a year which is preceding a general election.
All right. I think with that, that will be all. Thank you so much, Feroze, for taking time out and helping our viewers today. Thank you. We'll be slipping into a short break, but then post that, let's understand how to rebalance the exposure of mid and small cap in your portfolio. I'll be joined by Arun Kumar from Funds India after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and now let's switch gear to mid and small cap exposure. With a strong run-up, is it time to place or maybe rebalance your mid and small cap exposure in your portfolio? We've been hearing a lot of analysts saying that there's still little upside left in these categories. So what should be your strategy? Should it be a case where you need to go heavy on large caps? Let's get all this answered by Arun Kumar, Head of Research, fundsindia.com. Arun, good evening and welcome to The Money Show. And once again, we talk about mid and small cap in your portfolio. Talking about exposures, what do you think should be the strategy now? Also, when we talk about rebalancing, does it really mean that you need to rebalance your portfolio as per market caps, or if you're a long-term investor, these aspects can be ignored or maybe just left?
Yeah, so hi Kavita, thank you so much for having me on the show. So broadly, when you look at small and mid cap as a space, the reason why most investors want to get into this is that over long periods of time, there's a lot of evidence, not just in India, but also globally, that a small and mid cap exposure is able to outperform your large cap indexes by at least say 2-3%. And if you look at any small cap decent fund over a 10-15 year period, you can see that they're able to comfortably outperform the large cap index. Now, the next question is, if it's so easy, why aren't, should we put the entire amount into small caps? Now, again, any strategy which is easy enough to do will eventually get arbitraged away, because everybody will start investing in it and the valuations go up. So all strategies which end up outperforming your large cap index have to have something in it which makes it very, very difficult for an investor to stick to the strategy. So in this case, small caps come with a lot of temporary declines, and the extent of it is very, very high compared to large caps. In a large cap, every year, the temporary volatility that you generally see, if you go by the 40-year plus data, is roughly around 10-20%. Whereas in small caps, it's almost 20-30%. So in fact, in the last 18 years, you almost had a fall of more than 20%, 9 out of 18 years. So which means every 1 out of 2 years, you mentally have to be okay with a temporary fall of more than 20%. Whereas for large caps, it was just 5 out of the last 18 years. And on average, the intra-year fall has been 25% for small caps, whereas it's around 18% for large caps. So broadly, it's tough to hold on to this index, because every time it falls, you're worried that is it just a 20% fall, or is it a very, very large 50-60% fall, which probably happens once every 7-10 years. So most people end up selling out of small cap funds once it falls. And then again, when it goes up also, there's the temptation that should I time and then should I get out of it? So these are the challenges why it become very, very difficult to hold on to small cap funds. So how do we address this? There are 2 levels to address it. One level would be the simplest thing, which is net. You need to figure out how do I stay for say 7 to 10 years, right? So what you do is you overall cap your allocation to small caps at less than 20%, so that the remaining portion can go to flexi caps, large caps, so that the volatility is contained at a portfolio level. And the second thing that you can do is diversify it across 2 or 3 good small cap funds, so that you are not you are not dependent on a single pocket, and the fund managers can diversify it across different segments. The third is not to try to time it, and probably it's a very, very good category for SIPs because you stagger it over a long period of time. And the fourth is you also do the rebalancing once in a year. If let's say you have a 20% of your equity portfolio into small caps and it is crossed the plus or minus 5% band, say because of the current rally, say instead of 20, now it's gone to say 26%, then you can knock off 6%, move it into large caps or flexi caps and bring it back to 20%. So this is the level one thing where basically once you follow this and this will allow you to hold it on for 5 to 7 years and you will get a good experience. The level 2 is where you try to become tactical on it. So the 20% is fixed as your structural portfolio. It can be 20, it can be 10, it can be 5 based on your risk profile. So let's take 20% as an example. Then the level 2 is there are times where you can probably bring it up to 30. There are times where you can reduce it up to 10. Now, and this should obviously be done at extremes. And this is where we kind of use 5 lenses framework to figure out which is the time to go underweight and overweight. But broadly, the way we think about it is that 90% of the times we use a simple rebalancing metric, and only in that extreme 10%, we might want to bring it to say 30% or reduce it to go underweight to 10%. At this juncture, we are still at a level where we are just rebalancing it. We are neither going underweight nor are we going overweight. Probably I can talk about how we decide on this based on the 5 different lenses.
All right. Now, let's talk about the technique through which you can rebalance or maybe, adjust the exposure of mid-cap and small cap. We can see a lot of active funds, not performing better than the benchmark. Obviously, we've seen the alpha numbers also delivered by different mid and small cap funds. Now, talking about, it's always recommended to have an active strategy as far as this category is concerned of mid-cap and small cap. But then, looking at the way benchmarks have outperformed, do you think going ahead, because it's a very cyclical flow of these categories, okay, that we get to see, is it much better to maybe have a passive strategy going ahead?
So, see, at least in India, if you go by, I mean, this is obviously the last 6 months, a lot of funds have struggled because there are pockets which have become insanely expensive and any good fund manager would try to avoid it. So there will, in shorter time frames, it's very, very difficult to judge a fund manager. But if you look at any long time frame, say 5 years, 7 years, 10 years, then you see that most good small cap fund managers have comfortably been able to outperform the benchmark. So unlike large caps where a lot of fund managers are still are struggling to outperform, small cap is still, I think there's a long time left, and active fund managers are comfortably able to outperform the benchmarks, and the last 6 months might be an anomaly, but any longer time frame clearly indicates this. Now, in terms of how do you rebalance, so the rebalancing part, as I told, the level 1 is simple, that for every plus or minus 5% deviation from your original intended small cap exposure, you keep rebalancing. The level 2 is where you add the tactical. So what we do is we look at, instead of looking at just one metric, we look at it through 5 different lenses. One of the lenses that we apply is performance cycle, where we see over long, because what happens over long periods of time, large cap, small cap, mid caps kind of tend to converge, but there is an upcycle where small caps tend to do extremely well. So 2003 to 7 was an upcycle. Then 7 to 8, again, it fell and then it kind of converged with large cap. Then again from 8, 9 bottom, it again went up till 10. Then again it converged in 13. Then again from 13 to 15, 13 to 18 was an upcycle. Then again till 20, it went down. So you can see these kind of cycles happen. So where are you in the cycle is the first lens. Now, obviously, we are not in the bottom part of the cycle. We are at probably we're probably at the last phases of the cycle, because historically we measure it using mid cap to small cap to large cap as a ratio. And whenever it crosses 2, it becomes a little risky, because every time it crosses 2 was when the cycle turned the last few times. So the first long cycle metric is showing that it's become a little more dangerous territory. But again, if you look at the shorter cycles, where every time it falls 25-30%, how does it get back? We've historically seen the cycles, the up cycle again lasts for 18 to 24 months. This time we are probably 6 months into it. And again, the upside is close to 2 to 3x. This time, again, we are only at 1.5x. So the shorter cycle kind of indicates that, at least going by history, that there is probably some more legs left. But the longer cycle is again saying that, hey, probably we are in a dangerous territory. The second lens that we apply is valuations. If you look at small cap market cap as a percentage of overall market cap, whenever it crosses 15, it becomes a little on the higher side. Now it's almost at 16, so you need to be cautious. If you look at any price to equity, price to book, it's very, very evident that the valuations are on the higher side. So valuations is again a negative indicator for us right now. Again, if you look at flows, sentiments, the flows are insanely high on in the small cap category for mutual funds. The number of folios have increased. If you look at Google trends for small cap funds, small caps, it's all at an all-time high. And different parameters that we follow, most of it is showing that flows and sentiments are also hitting the negative, is showing a negative signal for us. So out of the three, most of them are showing negative for us. But what is showing positive is generally, to call it a bubble will mean that 5-year, 7-year returns become insanely high. Right now, we are somewhere close to 15%, which is very, very close to large cap returns of 13%. Generally, for bubbles to happen, the 5-year, 7-year returns are upwards of 20-25%. So right now, we are still some time away from it. And the last 1 year rally is vociferous. It's at least 50, 60, 70%. And globally, bubbles are usually have the last 1 year returns to be upwards of 100%. We are probably at 30% in the last 1 year. So again, past performance as an indicator is not showing any signs of a bubble. Again, if you look at the earnings growth environment, the consensus Bloomberg estimates are close to 20% plus for small caps over the next 2 years, vis-a-vis 15-16% for large caps. And again, when earnings growth is broad-based and macro is looking good, corporate balance sheets are great. So almost everything is pointing towards a very, very good growth environment over the next 2-3 years. So again, that is also a positive indicator. So putting it together, two indicators are negative. The cycle indicator is mixed, and the past performance and earnings environment indicator is so we are not in a position to go underweight nor overweight. So we will continue with the neutral stance.
Okay. Time to go overweight, or because the valuations are slightly comfortable in large caps, like can we go heavy, at a portfolio level? Do you think so? That will be a right strategy?
Yeah. So for somebody looking at incremental allocation, so if you're somebody who's always invested in small caps and you've already built your portfolio, then you can continue with your original exposure. But for incremental money, I would prefer flexi caps or large cap to be a better place at this juncture, because small caps are you need to be extremely careful on how you deal with it over the next 1 year. Obviously, there can be a lot more. There can always be upside because the flows, you do not know how long it continues. But you need to be extremely cautious. So I think incremental money is far better invested in flexi cap funds. But for existing invested money which you have built over the last 5 years, I don't see a necessity to go underweight.
That will be all as far the time is concerned, although I do have a lot of questions for you, Arun, but then the time is up. Thank you so much for being on the show and helping us with the strategy in mid-cap and small cap today. But then time for a quick break. Post that, we'll be taking your mutual fund portfolio questions on the show, and with me would be Nasreen Mamaji, who will be answering all your questions. Welcome back. There are a plethora of funds available in the market to invest your hard-earned money in, but how do you assess which is the right fund for your portfolio? What are the criteria that you should look at while choosing a fund? We have Nasreen Mamaji, a CFP Moneyworks Financial Services, to answer all of these questions today for you. Also, do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your queries on the Money Show at etnow.tv. Good evening, Nasreen, and welcome to the show. We also have our first viewer online, Shashwati Kannan from Chennai. Hi, good evening.
Hi, good evening. I'm very happy
How are you
that
doing?
My call is fine, thank you. I am Shashwati Kannan's father, Kannan.
Okay.
The phone number is mine, and I have only sent the inquiry for my daughter.
For your
Thank
daughter.
you so much. Happy
All right.
Vinayak Chavithi to all.
Thank you so much, Mr. Kannan, for sending us your query, and it's very nice that you are thinking about, giving financial protection to your daughter. In fact, you want her to invest. Okay, so we already have your questions. Is there anything else you want to add before I go to Nasreen to answer this query?
The query is absolutely fixed, madam. I have nothing more to ask. She is a beginner, just started earning a lump sum. So
Got
I
it.
need that advice.
All right. I wanted to understand how much will she will she be investing, because she needs 50 lakhs for higher education in 2 to 3 years now, right? So
Yes.
the goal is actually not very long term. So we cannot take a lot of risk. So I wanted to understand how much she will be investing.
Acha. Actually, that also I have mentioned in the following message. The thing is, she is planning to go for higher studies. That doesn't mean her target period is only 2 years. It can be,
Okay.
as per the advice.
Okay, got it. But any lump
Yeah.
sum amount that she might need, she needs 50 lakhs. Any idea how much she'll be investing per month?
Per month, she can go up to 50 to 80,000 rupees, depending on suggestions
50
and
to 80. Sure.
target.
All right. 50 to 50 to 80. All right. I think we are clear with the question. So I will just move to Nisreen. So Nisreen, very interesting, because also the amount that's needed is 50 lakhs in 2 to 3 years time, and the investment amount is around 50 to 80,000 per month. I think the place where we get stuck is the investment instrument that Shashwati can go for. Considering the kind of short duration, we cannot even recommend something that's very equity oriented, might be very risky for her. How do you suggest she pursue this goal of higher education? Education loan could be a part of this particular goal as well. Would you recommend that, considering the shorter duration time? Sure. Please go on. Yeah.
Yeah. So basically, she's going to have a shortfall. If she needs about 50 lakhs in 3 years at an assumed growth rate of about 12%, the SIP amount, or the monthly investment amount needed, will be about 1,16,000. And if you're going to put a lump sum, then we need about 35.5 lakhs, at the same rate of expected return. So if her investable surplus is, say, in the range of 50 to 80,000 per month, then there will be a shortfall for which a loan will have to be taken. Also, as far as the instrument is concerned, I think a balanced advantage category for 3 years works very well for her. Typically, the thumb rule for somebody in the younger age group is 100 minus your age. That should be your equity allocation. In this case, the goal is much earlier than the planning allows us for. If that is possible, if you have a longer time frame, then you can always be invested about 75% in equities and say about 25% in fixed income. But here, since the goal is only 3 years away, a balanced advantage category will suit her. This would include about 30 to 35% in direct equities, say 30 to 35% in arbitrage, and the rest in fixed income or bonds, which will give the product a certain amount of, safeguard the planning from volatility, and at least have some kind of return at the end of 3 years. Because without equity, we will not really meet the goal at all. So we can't go 100% into fixed income.
All right, Mr. Kannan, is there anything else you want to ask Nisreen?
Yeah, well, that's okay. But I am not particular about 50 lakhs in 2 to 3 years. As I said in the beginning, that's her requirement. But her allocation of funds towards mutual funds or direct equity or insurance, like that, I need to know the percentage from whatever.
I would recommend.
Sure.
No, I would definitely recommend that you take the mutual fund route. Direct equity might be a bit risky because it's not possible for us to predict the exact stocks that you might need that will give you the required return. So, in mutual funds, there will be a set of researchers, analysts, and it's a very transparent instrument. So one should definitely take advantage of that. An insurance product, on the other hand, the charges will be very high. Also, all the insurance companies are not doing their in-house investment, activity themselves. So it is better for us to invest with an investment company or an asset management company and let them do the job. And direct equity, I would not recommend to a retail investor because you really won't have the time to select the stocks that could possibly give you the return that you desire.
So, via mutual funds, Mr. Kannan, it's recommended that you enter the share market and achieve this goal. And the further diversification across asset classes should be done at a portfolio level. But all the best to Shashwati, and we really hope that she achieve this goal of higher education. We move on. I have Mr. Balupaki from Chandigarh online with me. Hi, good evening. How are you doing today?
Good evening, ma'am. I'm fine. What about you?
I'm doing good. Thank you so much. So we have your question. You started investing 5,000 in Edelweiss Nifty 50 index, and you want to understand if you can continue or you can shift to any other passive fund. And you also want to invest 15,000 monthly in mutual funds, and you want to understand the allocation across market caps. And congratulations, you are just 22 years old, and that's want to begin your investment journey. Are you also reading up and trying to understand the markets, and because of this reason have you selected this fund in which you're already investing?
Yes, ma'am. Yes, ma'am. Actually, I have started like 2 weeks ago. Like I focused on investing my hard-earned salary. So after going through a lot of research, I found that mutual funds will be beneficial and will give good returns in the long term. So
definitely. Congratulations, and very inspirational for all the viewers who also might want to up the same kind of strategy. So Nisreen, what funds for him?
He's asked for an alternative. So I would think the UPI indexed, the 50 index, or as well as the ICICI Prudential Nifty 50 index fund has given slightly superior returns to the Edelweiss fund. It would have the same benefits in terms of the cost structure, because any index fund or an ETF fund would give you the superior returns slightly, better than an actively managed fund. But having said that, cost is not the only factor that you would use to, select your fund. The actively managed funds, the returns are far better. So of course, the costing is higher because there would be, active fund management. So I would definitely recommend that, you've asked for asset allocation for 15,000 rupees per month. And there I would recommend actively managed funds. So the asset allocation would be about, say, 1/3 into a multi-cap fund. I've recommended the Nippon India multi-cap, HDFC mid-cap opportunities for about 2,000 rupees, Nippon India small cap for another 2,000 rupees, 1,000 rupees in Kotak equity arbitrage. This will take care of, slightly shorter term needs that you might have, because sometimes we don't foresee our short-term requirements, our emergency funds, loss of jobs, etc. So this could be your emergency fund that you might need, God forbid if there is a loss of job, etc., or a medical emergency in the family. And I've also recommended ICICI Prudential India Opportunity Fund, which is basically an opportunistic kind of fund. It will select the current themes which will do well, and it will automatically change the sectors or the themes every few years. So there I have recommended 5,000 rupees as well. So it's like a 1/3, 1/3, 1/3 breakup. And this is the names of the funds I've already mentioned to you earlier.
All right, that will be all. With that, it's a wrap. Thank you so much, Nisreen, for being on the show and helping our viewers with their mutual fund queries today. Thank you.
Thank you.
On that note, time to sign off. I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your questions, be it mutual fund or anything insurance or even tax-related queries. You can send us on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.